Welcome to the Deep Dive. We take complex topics and try to make them make sense, get to those insights that really matter. And today it's all about accounting, especially for businesses here in India.
Numbers tell a story. We just got to learn how to read them.
Exactly. And I'm really excited to have someone here with me today who can help us do just that. Someone who can connect those, balance sheets to the real world financial picture.
That's what it's all about, making sure you can understand those statements and use that knowledge.
Okay, so let's start with the absolute basics, like the foundation of accounting, or we're talking about the fundamental equation, right? Assets equals liabilities plus equity.
It's a simple equation, but it's powerful.
Right. It's like, EMCTS for physics?
Yeah.
This is like the accounting equivalent of that.
Think of it this way. You have a business owner, right? Maybe in Bangalore. They want to expand their factory.
Oh, yeah.
This equation shows them, do they have enough assets to maybe take out a loan? Or do they need to get more equity, to balance things out?
So assets are what the business owns.
Right.
Liabilities are what they owe.
Yeah.
And equity, that's like the owner's stake in the business.
Mm-hmm.
What's left over after, everything else is sorted out.
Exactly. And if liabilities are bigger than assets...
Uh-oh.
Yeah, that's a warning sign. Imagine a homeowner in Mumbai, their mortgage is worth more than their flat.
Oh, wow.
They're in trouble, right? And
Well,
so Liba is a business in that situation.
So this equation, it helps us see how financially healthy a company really is. Okay, so let's focus on equity for a second.
Yeah.
What makes up that part of the equation?
Two main things. Common shares and, what else? Retained earnings.
Okay, so common shares, those are like little pieces of ownership.
Exactly. You buy shares on the NSE, you're getting a slice of that equity pie.
Got it. And retained earnings, is that like the company's savings account?
It's the profit they kept.
Yeah.
Instead of giving it out as dividends.
Oh, like fuel for growth, for investing in new things, expanding, or maybe just having a buffer when times are tough. Dividends. That's those payments shareholders get, right?
Right.
So how do those affect retained earnings?
Imagine a company, say, Infosys.
Okay.
They pay out dividends, right? That's like sharing a portion of the profits. So retained earnings go down because that money is going out.
So it's like a balancing act. Reward investors today or invest for a bigger future.
That's the challenge.
Okay. Well, speaking of rewards, let's talk about profit or net income, as the accountants like to call it. It's the bottom line, the number everyone cares about.
Net income tells you how much the company actually made, after paying all the expenses.
Right. So how do you calculate that?
Revenues minus expenses equals net income. Imagine a street food vendor in Delhi.
Okay. Yeah, I love those.
Their revenue is what they make selling all that delicious samosas and chant and expenses. That's the cost of ingredients, rent, all of that. Whatever's left over, that's their net income.
So if they make, say, $10,000 selling samosas and chant, but spend $6,000 on all the other stuff, their net income would be $4,000.
You got it.
Yeah.
It's pretty straightforward, but a single year's profit doesn't tell the whole story.
Really? I thought profit was always a good thing.
Oh, it is. But context is key. You got to look at the trends. Is the profit going up each year?
That makes sense.
Is it higher or lower than their competition? Like other street food vendors in Delhi, that gives you a much better picture of how they're doing.
So profit is just one piece of the puzzle. We need to look at past years, the industry, and competitors to really understand what's going on.
Exactly. It's about the nuances. A company might have a good profit, but what if their competitors are growing way faster? It's something to think about.
Okay, so we've got profit figured out. But to really break down a company's finances, we got to talk about the big three, the financial statements, income statement, statement of changes in equity, and the balance sheet.
They work together. Tell the company's financial story.
So it's like reading a book. But instead of chapters, we have these three statements.
I like that. The income statement is like the plot. Shows revenue, expenses, and that bottom line, net income.
Okay, yeah.
Then you've got the statement of changes in equity. That's like character development. Shows how equity has changed over time.
Interesting.
And the balance sheet, that's like the setting, gives you a snapshot of assets, liabilities, equity at a specific point in time.
So they're connected. It's not like three separate stories, right?
Absolutely. The net income from the income statement.
Yeah.
It flows into the statement of changes in equity, which then updates the balance sheet. It's all connected.
I see. It's like one big financial narrative.
Precisely.
Okay, now let's get into the nitty-gritty. Journal entries. Accountants are always talking about these. What are they all about?
They track every single financial transaction. Meticulous, but important.
So every time a business, let's say in India, buys supplies, sells a product, pays their electricity bill,
It all gets recorded.
as a journal entry.
Yep. Every single one uses debits and credits. Make sure that accounting equation stays balanced.
So it seems complicated, but it's all about keeping that balance. Assets equals liabilities plus equity.
That's the core of it.
Okay, so give me an example. Let's say a clothing store in Mumbai buys new mannequins, like
Yeah.
$50,000 worth of mannequins.
All right, so the mannequins, those are an asset for the store. Their assets go up.
Right.
We debit the mannequins account for $50,000. And to balance that, we need a credit. Let's say they paid cash. So we'd credit the cash account for $50,000.
So every transaction has two sides.
Yeah.
Debit and credit. Always keeping that equation in check.
That's the system.
I'm starting to get it. It's all about balance.
Exactly. Every move gets recorded, no matter how small. But journal entries, that's just the start. Sometimes you got to make adjustments to really show what's going on financially.
Adjustments. What kind of adjustments?
Take prepaid insurance, for example. Like you've got a tech startup in Hyderabad.
Okay.
They pay $12,000 for a whole year of insurance. At first, it's an asset.
Right.
But every month,
Yeah.
part of that insurance gets used up.
It's like when you pay for a year's worth of chai all at once.
Yeah.
You've got that credit, but each cup you drink, you're using a bit of it.
We got to adjust the books every month to show that. Lower the prepaid insurance asset, increase insurance expense, because a part of it's been used.
So it matches reality.
Oh,
What's happening over time, not just at one specific moment.
that's the idea.
Makes sense. What about depreciation? I hear that word a lot in the financial world, I mean.
It's about recognizing that things wear down. Assets, like a delivery truck.
Oh, right.
For an e-commerce company here in India, you're spreading the cost of that truck over its useful life.
Like it starts shiny and new, but all those deliveries,
Yeah.
it's going to lose value.
Say the truck costs 10 lakhs and it'll last 5 years.
Okay.
You depreciate it by euro 2 lakhs every year. Shows it's worth less over time.
So it's a non-cash expense, right? It's not like they're actually paying out euro 2 lakhs every year.
Right. It's just reflecting the truck's real value. Now let's switch gears a bit. Talk about accrued expenses.
Accrued expenses. It sounds complicated.
Nah, it's simpler than it seems. Think of like a manufacturing company in Chennai.
Okay.
Employees are working hard in December, but payday isn't till January.
I see.
They've already got that expense for salaries, even though the cash hasn't gone out yet.
It's like they earn the wages, even though they get paid later.
You adjust to show that December salary expense, even if the cash goes out in January, shows the real economic activity.
It's all about timing, isn't it?
Yeah.
When things happen versus when cash actually moves.
Gotcha. Okay, so accrued expenses, it's all about timing.
Right.
And then there's accrued revenues, like the flip side.
Exactly. The company earned it, but hasn't gotten the cash yet.
Like imagine a design agency in Bangalore.
Okay.
They finish a project in December, but the invoice doesn't go out till January.
They've earned the revenue, even though the cash is coming later.
Like finishing a beautiful Rangoli
Hmm.
right before Diwali.
Uh-huh. Yes.
You did the work, but you get paid after the festival. You adjust to show that December revenue, so it's accurate.
Accrued expenses, accrued revenues, all about timing. Okay. What about unearned revenue then?
That's when a company gets cash up front for stuff they haven't delivered yet.
Like those subscription boxes everyone loves.
Yeah, those are a good example.
Pay for a whole year, but the company only earns the revenue each month as they send the boxes.
It's a liability at first. They owe you those boxes. But as they deliver,
It becomes revenue.
right, it's about showing the obligations accurately and when revenue's actually earned.
Okay, so journal entries, adjustments, all these different revenues and expenses. What happens at the end of the fiscal year then? How do you wrap it all up?
Closing entries, it's like hitting reset on certain accounts.
Like cleaning up after Diwali? Putting all the decorations away carefully for next year?
You close out those temporary accounts, revenues, expenses, dividends, all that gets moved to retained earnings.
So all those individual accounts, all those details, it gets summarized in retained earnings, showing the big picture, the impact on the company's equity.
Exactly. It shows the company's profitability over time, not just for a single year.
Makes sense. Okay, we've closed the books. Everything's nice and tidy. What about Bank reconciliations, is that like checking your receipts to make sure you haven't been overcharged?
It's about making sure your records match the bank's, catching any mistakes.
So you compare your bank statement to what you have in your own records. Make sure the cash balance is right.
Imagine you deposit a check, but the bank hasn't processed it yet.
Okay.
It's on your records, but not on the bank statement.
Or you wrote a check, but the vendor hasn't cashed it. It's deducted from your records, but not the bank's.
Bank reconciliations find those differences, explains why the balances might not match. It's super important for accurate records, making sure everything adds up.
It's like double-checking your work.
Exactly.
Okay, so cash flow is all squared away. Now let's talk about inventory. That's got to be a big deal for companies with, actual physical goods.
Inventory it's the core of retail, isn't it? All that stuff they have ready to sell. Raw materials, finished products, all of it.
So like a bookstore in Kolkata. All those books on the shelf, just waiting for people to buy them, that's their inventory.
Exactly. And managing it well, that's key for making a profit. Too much inventory, you're tying up cash, and things might get outdated. Too little, you miss out on sales.
Got to find that sweet spot. So how do companies keep track of all that inventory and, how much it's all worth?
That's where inventory valuation comes in. There are different methods, like FIFO, first in, first out,
Okay.
and then there's weighted average. Each one has its own way of calculating the cost of goods sold and what's left on hand.
I bet choosing the right method can really change those financial statements.
It can, affects profits, even taxes.
Yeah.
Now, let's talk about something every business in India deals with: sales returns and allowances.
Oh, yeah. Those dreaded returns. It's like when you buy a sari, for a special occasion. Get home, and it just doesn't fit right.
It happens. It's normal in business, especially retail. But it does impact revenue.
So if someone returns that sari, the store has to adjust their sales to show that return.
Exactly. Credit the sales revenue account, debit an account called sales returns and allowances. Keeps the statements accurate.
It's all about balance, isn't it? Making sure everything reflects what actually happened. Okay, so we've talked about assets. Short-term, like inventory. Long-term, too. Now, how about raising money to, actually get those assets in the first place? Let's talk bonds.
Bonds are like IOUs. Companies use them to borrow from investors.
So instead of a bank loan, they go straight to investors.
Right. And bonds have interest rates. Determines how much the company pays each year.
Like they're paying rent for borrowing the money.
Good way to put it. Now, the interesting part. Bonds can be issued at a discount, at par, or even at a premium.
Depends on what.
Market interest rates, how creditworthy the company is, things like that.
So discount means it's sold for less than its, face value. And premium means more.
Exactly. And that discount or premium, you got to account for it over the life of the bond.
It's called, what was it?
Amortization affects the interest expense each year.
Spreading out that extra cost or the savings over the whole bond term.
Right. Now let's look at shareholders' equity. It's the part of the balance sheet that shows, the owner's stake.
It's like the company's net worth. What's left after all the debts are paid?
Shareholders' equity has two parts: contributed capital and retained earnings.
Right. Retained earnings. We talked about those.
Contributed capital, that's the money from shareholders, from buying shares.
Like the initial investment to get the company started or help it grow.
Exactly. And retained earnings. Well, we know those are the profits the company keeps, instead of paying them out as dividends.
It's like their own internal savings to fuel growth and future projects.
Right. And dividends, those are the payments to shareholders, sharing the profits with the owners.
Like a reward for investing in the company.
That's one way to think about it. Now let's move on to something really important for understanding a company's finances: statement analysis.
Statement analysis. Sounds kind of like detective work, Using the statements to find clues about how the company's doing.
I like that. You're using tools and techniques to really dissect those statements, find those insights.
So it's not just reading the numbers. You're looking for trends, patterns, things like that to understand what's really going on.
One common technique is ratio analysis, comparing different numbers on the statements to see how they relate.
So instead of just looking at profits, you might compare them to sales to see how efficiently they're making money.
That's called the profit margin ratio. Gives you a much better picture than just profits alone.
I'm seeing how these ratios can really give you a deeper understanding. What other techniques are there?
Trend analysis is another one. Looking at how the numbers have changed over time, like tracking revenue growth over 5 years. See if they're moving up or if things are stalling.
So you see the whole journey, not just a snapshot.
Right. And then there's common size analysis. You express everything as percentages.
Makes it easier to compare companies of different sizes, right?
Yeah, or to track a company over time, even if the numbers themselves have changed a lot.
It's like leveling the playing field.
Exactly. With statement analysis, you can answer all sorts of questions about a company. How healthy are they financially?
Are they making enough money? Are they taking on too much debt?
It gives you the tools to understand those financial statements and the company's story.
Wow, we've covered a lot today. From the very basics to analyzing statements, understanding cash flow. It's been a whirlwind.
It has been a journey, but hopefully you've learned something about accounting and how it can help you make more financial decisions.
Definitely. I used to see numbers, and they just didn't mean much. Now I see a story, and I have the tools to understand it.
That's the power of knowledge, especially financial knowledge.
Well, a huge thank you to you for guiding us through this deep dive into accounting. It's been amazing.
It's been my pleasure. Always happy to talk finance.
And to everyone listening, thank you for joining us for the deep dive. Hope you enjoyed this look into the world of accounting. It's pretty fascinating stuff.
Remember, knowledge is power, especially when it comes to your money.
Absolutely. Don't forget to like, subscribe, and share this episode with anyone who wants to understand business better. Until next time, keep those financial statements balanced.